We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners at Burke Britton Financial Partners. This is the Finances podcast. It's not an episode number. We're going to call this a market update. Ben, are you happy with that?
Happy with that, perfect.
We don't need much backstory for today's guest, Adam Dawes, Senior Investment Advisor at Shaw & Partners. He's made the trip down especially for us today, straight into Avalon. I'm glad you took our advice to...
Finally took your advice.
Flew into the shed and then taxi here. So, Adam, listen, we haven't got much to talk about because nothing much has happened in the markets. There's nothing going on. I suppose the way we wanted to run this market update, you correct me if I'm wrong, Ben, but we thought we'd start, we've got plenty of sort of macro things happening, and we might finish off with some stock stories, or Ben's got a list from the team out the back about stocks we want to talk about, lots of things that clients are interested in. So let's talk about what's happened in the last month, mate. I know we're in December. What's the date today, Ben? Is it the 6th, 7th? 6th. It's the 6th of December. We're a month post US election. There was lots and lots of noise and excitement and pessimism. There was everything in the lead up to the election. How's it actually rolled out? What have we seen? Is what you anticipated actually happening? And what's the outlook?
Yeah, so we had a fair bit of money sitting on the sidelines waiting for the election result. I think it was a little bit tough for us to sort of pick a direction when you really didn't know how it was going to all roll out. And obviously Trump won, so we started to put some more money to work on the back of some certainty about what's going on. Now, he does have some very good economic policies, whether you love him or you hate him or whether you're in between. He does actually have some very good economic policies, but a lot of the tariffs that I think that will be put on the rest of the world is going to slow down global growth. It won't happen next year, but it will definitely happen 26 and 27. There will be a slowdown. He's also going to cut tax rates, corporate tax rates as well as consumer tax or normal tax rates, and everyone's going to have a little bit of extra money in their pocket. So next year is going to actually be really good because the economy is going to fire because of all this extra money. But what they're going to do is work out that all of these tariffs, when then the businesses start to raise their prices to compensate for the tariffs, they're not going to have much money left after it all anyway. So it is, so 2025 I think is going to be a very good story for us, and markets are going to do well. 26, 27 gets a little bit murky as to how things are going to pan out and the way it's going to work. But certainly December has been a good month for the markets. We're sort of in the midst of our Christmas rally or our Santa rally at the moment. Markets hitting sort of all-time highs of 8,400 plus, and that's been fantastic, going forward. Obviously, the banks have been the big story over the last 6 to 12 months of this year, where we all said that banks should start to fall, and every broker, every research house has got it wrong. Absolutely, I'll put my hand up and say we got it wrong also. Commonwealth Bank sitting at $160, 55, 58, 60, where it is today, is the most expensive bank in the world, hands down. There is no more banks that it is the highest, the most expensive bank. And I think that allows us to feel like, well, we're justified by trying to reduce clients' portfolios of the banking sector, but overall, it's a really tough sell. And in fact, I've given up trying to tell clients to sell their Commonwealth Bank because it just doesn't work. And they've been, the clients holding it, they've been right. They've absolutely been right. But that's going to be an interesting story because most of the financial sector has been doing the heavy lifting this year. The resources have lagged. And for that, we need to see a switch around. We need to see the resources starting to fire to keep this market where it is. We also need to see that a broad-based rally. We need to see the ASX 300, ASX 500, and we need to see the Russell 2000 starting to move to keep that broad-based rally moving, because it's all been in the top 50, the top 10 stocks in the US and top 50 here in Australia have been moving the market forward. So yeah, it's been an interesting December, but I think January hopefully calms down a little bit. We've got President Trump to come in. and he's going to start to make waves. And so I think every day that we come in for the next 4 years, for all of us, is going to be a very different story, because we're going to wake up going, what is going to happen today and how we're going to position ourselves, because it's going to be really tough.
Jump on Twitter as soon as you wake up and start seeing what been flicked out overnight.
I saw a really great chart of the frequency of the tweets, Trump's tweets, versus the volatility of the market. And
Is he back on Twitter?
Yeah, well,
Surely him and Elon
yeah.
fight again now.
I don't think he is.
What's he running?
He's got his own platform.
Truth Social. Yeah, I don't think he reposts. Other people repost his Truth Social tweets. I don't think he's actually back on, but Elon's given it a good nudge. He posts about every 3 seconds, I think. So,
yeah, but definitely the volatility of the market is correlated to what he's saying on social.
yeah, that's right. Yeah, you were mentioning just off air, I think, before we hit record, about how interesting it was. You've been telling clients for, the sort of roller coaster of investment emotion, and you've been telling clients for a while to invest. And it's funny now that things are at all-time highs. We're talking about crypto, but also just markets in general. People want to invest at the very pointy end.
Yeah, it's crazy, because all the work that we did 2 years ago and getting clients in and getting to understand things, and with you guys as well, putting the money in, and then now starting to see it all starting to pay off. Not that you ever get complacent, but you're sort of having a little bit of relax, going, okay, it's going. But yeah, we're constantly getting people now going, I want to get into the market, I want to do this, I want to do that. And you're like, where were you a year ago when we were talking about, or a year and a half ago, talking about, let's get in now, now's the time. And then, so it is a bit of that retail mindset, which is a bit tough.
Which we see all the time. And it's just one of those human nature things, isn't it, where people see everyone else benefiting and they want to join the party. Yeah. If you can be rational and use you're looking at the valuations, you're looking at the raw numbers behind it, then that's really what you need to look at. And that's why you knew a year ago or 2 years ago, things can sort of only go one way almost from here.
But, Commonwealth Bank, $100 it was expensive, 120, 130 it was expensive, 140, 150 is expensive, so can you put a client into Commonwealth Bank at $160? It's really, really tough. But the reason why I think we've seen a lot of these financial stocks and bigger stocks really sort of going is, one, we've got a superannuation industry that's over trillions and trillions of dollars, and it's got to stuff money down a very small hole, which is the ASX and the ASX top 50. And so they just keep having to stuff it down with all of this index buying from ETFs that are constantly just coming in. And it's not institutional money. Instos aren't really doing a lot of ETFs. It's the retail market just going, I'm just going to buy an ASX 200 and I'm done, right? And so there's this massive amount of money being stuffed down a very small hole. Then there's a lot of Asian money coming into Australia because they can't invest in China. So you get a lot of this international money coming through to Australia being a pseudo exposure to China. And again, the finance sector is a safer place. So all of these things just moving towards and pushing these things higher. It's hopefully that the resources stocks then get the same love.
Do you think that when you're talking before about that broad-based rally, that's where potentially their value lies, is in there because they haven't had that? It hasn't dragged them up with it yet.
So, rising tide lifts all boats, right? But we haven't seen that. Yeah. So Magnificent Seven, so 50% of the returns have been done by 7 companies in the last year. Here in Australia, it's been that top 50 companies, but it's been a horrible time for the small caps. The small caps have been... only this year have they started to sort of raise their head a little bit above and sort of start to make a move. But it's fraught with danger and it's tough in that small cap space. But some of our portfolios in the small caps have been doing sort of 40% plus in the year. So we're starting to see that broad-based rally. And the Russell 2000 is a great one to look at for that sort of barometer of how the overall S&P 500 for the market, but the Russell 2000 is a great indicator of how the broader economy is actually working, and it needs to fire for it to continue.
Does interest rates potentially easing in the new year have a big factor on those smaller caps, or is that not been an overriding?
I think it yes, but I think it provides, not directly, but I think it provides confidence in the market that yes, we've already seen a 75 basis point will decrease in the US, UK, New Zealand. There's all these European countries that have been reducing interest rates, which is giving confidence for them to go further out of the top 10, top 50 to then potentially look at that. So yes, it does, but it's not a direct correlation, but it's confidence, and you need confidence to have in investing in small caps.
It's that whole sentiment thing that, again, and we see it as well with the property market, even domestic, like locally to this area, and people sort of, again, they're waiting for it to turn before they start to consider it again. Like, they don't want to be everyone tries to pick the bottom, don't they? You're never going to do it. No, you just got to use the averages and what you've got.
And you've always got to leave a little bit on the sidelines for people as well, like a little bit, like you're just never going to pick the top or the bottom. So be comfortable in sort of that mid-range. But yeah, I mean, picking stocks is probably a little bit easier sometimes because you can see value or you can see where things are going. But yeah, that sentiment needs to still continue on, and hopefully that does carry through into the new year.
The Commonwealth Bank story is one that, again, a lot of people understand it because they know what it is, but it might not be exiting entirely, even though that might make sense. Is just take some. Yeah. Take something out, like take a bit, because you can see value elsewhere.
Those clients, so that you're a bunch of them that have been attached to that stock for.
That's the challenge with it, is they've held it forever.
And it go up.
It's it has gone down over time, but it's always paid its dividend, and
they got it right when the brokers got it wrong, so they think they know best.
Yeah. When now you think, you got, to an extent, you probably defied the odds. Like, now you really need to cash out some of that, because it's gone up 50% basically in a year,
easy,
essentially. If you look back, I was showing a client in this graph trying to sort of help them understand why. Like, if you track it back over the last 2 decades, like, it's always gone up. But if you look at that graph in the last 12 months, it's nearly vertical. Like, it's just gone whoop. So that's it.
So the difference between, and Commonwealth Bank is a classic example of, it's an emotional versus the fundamentals. The fundamentals are that the net interest margin has been compressed. Commonwealth Bank has only got mortgages in Australia, so there's only 28 million people mortgages. There's only a certain amount. So the fundamentals are saying that it's a sell, screaming sell, and that's been from $100 up. So like I said, we all got it wrong, but it's the emotional attachment people have to it that they just can't let it go, and you can't fight against that emotion. Like, you can look at the fundamentals, you can do the charts, you can do all of that, but the emotional attachment is far too greater, and hence why I've given up.
I think Australians are terrible at it too. Like, Aussies have this real loyalty. And I say, like, the bank doesn't, well, that investment, it doesn't really care about you, to be honest. Like, they don't give
charging you another $3 to take your cash out now. So, they're trying to make money. And, people will pay their mortgage before they eat, right? So that's the psyche. And then the banks are the ones that supply that or support that mortgage, so they're going to be loyal to that as well.
Yeah. I suppose, again, that maybe the compelling part needs to be, where do those funds go to? Like, what are these other sectors or specific stocks that you go, okay, I've agreed I'm going to sell 1/3 of my Commonwealth Bank holding and take some cream off that. Like, where are we going?
So first port of call would be something like a Macquarie, right? Because it's a global bank. Right, so that, I think, is something that you could look to say, if they don't have Macquarie there, then Macquarie, being a global bank, CommBank is very much Australian mortgages. That's pretty much it. So I think something like that would be a good starting point. From there, if they've already got Macquarie or they're overweight the financial sector, resources haven't done the heavy lifting, so there's potentially there. Or we could look at some fund managers. Yeah, GQG is a great example of a really good fund manager, and they pay some good dividends, some things like that. So there's some other ones to do that. My first port of call would be something like a Macquarie, just to diversify.
Yeah, and again, it's the banking component, but there's just so many other arms to that.
Yeah, it's a money-making machine. Yeah, it's a great business. So yeah.
With again, one of the ones, and this is where Brooklyn had hit me up and said, let's talk about this, because I think a lot of the clients ask about it. And Sam, I know if he was here, I'd probably have to wind him up in 2 hours. It was about Sam Crompton, about uranium, and again that sort of coming back online is something that we really need to be looking at, and taking some opportunities in that space. I think a lot of people, through lack of education, and agreed with Sam's comment the other day, is that they're scared of it because they just don't understand what it is. They think that we're making nuclear missiles or something like that. majority of the world, I think, classing as green energy, probably everywhere except for Australia. Why now in that space?
Well, I think, I mean, you're absolutely right. It's an education piece, and I think that's the most important thing, is to sort of work through that. And obviously, people have very clear memory of Fukushima, Chernobyl, what's the dam down in Jabiluka, and then there's a dam in Tasmania that was all those fighting about. So all of those kinds of things is there's underlying uneasiness. And then, you throw in the ESG over the top, and obviously the environmental social governance, but the environmental side of, and not one state is allowed to mine uranium. It's banned still here in Australia. So governments don't like it, people don't like it. But what's really changed our minds on it is now that you've got very large companies, Microsoft, Meta, Yahoo, all looking for power supplies that are consistent, and it needs to be there for baseload power. Now, renewables, if the sun doesn't shine, there's no power. If the wind doesn't blow, there's no power. But for these small, medium reactors, they're called SMRs, but small, medium reactors, Yahoo, Microsoft and Meta just the other day they're not waiting for governments to get involved. They need that power for their AI machines, because the AI machine, so one AI search is like equivalent to 50 Google searches or something like that. So the power that is needed to get these AIs to move and to do it, they need a reliable power source. And so they're coming to the market and saying, we need uranium and we need a reactor to power, and it is a green energy, because there's no waste. I mean, there's a little bit of waste, but it's doable, and they can't rely on normal wind farms and solars, those kinds of things. So that, I think, is what led us to really start to pushing that uranium side of things, is that governments should now start supporting it. You've got big business supporting it, and it does have less environmental impact than coal or some of the existing infrastructure that we have at the moment. So that's led us to, okay, we need to then start to look at the uranium stocks, look at the commodity, and start to be in on that. And to Sam's credit, it was about a year and a half ago that he was starting to sort of rattle the cage and sort of say, look, now's the time. Maybe we were a little bit early, but we're now seeing all these larger companies, everybody's starting to come in, and that's proven that we're confident to keep going in that space.
I think the other side of it is that, again, over the last few decades, the safety and the technology around the use of it has improved so much as well that, again, no one wants to be the face of that next disaster.
Yeah, you just don't want it, and that would be horrible for anybody. And Chernobyl, like things do happen, and people move on. But you're right, it can't happen like that. So technology has definitely gotten better, and the way we use power has also gotten a lot more efficient as well. So these smaller reactors versus the Simpsons big tower, Homer goes to work at, they're no longer the kind of things that they'll do. And plus also the government's talked about a lot of coal-fired power stations that are closing down. They're going to refit that with uranium and make these smaller nuclear reactors that are there, which is the grid's there, the power's there, it's all there. The staff are there, so people still continue to get jobs because these coal-fired power stations are closing down. So it totally makes sense. But there's this emotional, again, it's that emotional attachment to the bad things that uranium has, and that's sort of where we are today.
I think eventually we'll probably, again, it's just about how long until we follow suit here, basically.
Yeah, I mean, obviously you got Paladin, and we've got Next Gen, which we've done really, really well in, and that'll be taken over, I reckon, in the next 12 months.
Do you want to talk to Next Gen? I know a few of our clients talk to Next Gen as a company and what they do.
So there, Lee Kernahan is an Australian. He's pegged out some land in Canada around Cigar Lake, which is the biggest where Cameco is, and they've basically pitched out all this land, and so it's basically going to be the biggest unrestricted uranium deposit in the world, the highest grade and the best quality there. They just last week announced that they've got some offtake agreements of £5 million. That's their first offtake agreement. Offtake agreement means that someone's willing to buy that uranium off them at a spot price over a 5-year period. And so, yeah, that's a real positive. But what we see is that they've already started to get some regulations. They need to get regulation to be able to pull the dirt out, or the uranium out of the dirt, and they've got these regulations. They've got the first regulation, I think that was 2 weeks ago now, or last week, that got pushed through. And then in the next 2 to 3 weeks, then there should be another tick from the Canadian government to do that. But why we really like NextGen, obviously it's a fantastic business. They're going to have to raise a lot of money to get this project underway, but we don't think that that'll happen because Cameco, which is the largest a Canadian uranium producer who has offtake agreements with a lot of people, they don't have enough uranium to actually supply those offtake agreements. So they actually have to go into the spot market to buy that uranium to then produce, just to sell that out. Now, Cameco's got a mine life of 2 years. NextGen has basically going to get these projects up and running within the next 2 years. Cameco is going to, I might disclaim right here. Disclaimer, please seek professional advice before you do anything, is that we think that Cameco, just like Newmont did with Newcrest, Newmont had a mine life of 2 years, Newcrest had a mine life of 21 years. They basically came in and took Newcrest out because they needed to keep their mines and keep that project going and funding it, and they did that by buying it. We think Cameco's going to do exactly the same thing. They're going to come through and they're going to buy NextGen. But they won't buy NextGen until those regulatory approvals are all in place, and then it's just an easy lay down that they'll take this out. So again, that is me drawing two lines and trying to draw how that's going to happen. If NextGen do decide to come in and produce it and put the project together, there's a couple of $1 billion they're going to need to raise, but I don't think they'll need to do that because I think Cameco will come in and just take it over.
I'm thinking about this from a consumer level. Like, think about the change. Like, think about AI, for example. I've got 2 AI bots running at the moment here.
I was going to say, you're probably, they need to put a whole uranium mine in just for your AI.
Yes. But on how many people are now, you think about how ubiquitous AI is already and how much people are using it. If you connect the dots, like you said, if you connect the dots between that and the energy requirement, which I think is the missing link for most people, they just have a consumer level device that they're using AI, they're using ChatGPT, they're using Copilot, they're involved in the Microsoft ecosystem with their business. If you can draw that line between that and the energy required and not necessarily correlate it with Russia, Ukraine throwing nukes at each other, it tells a very different story.
Yeah, absolutely. As well as then, that's why we've seen the rise in data centres, and data centres are a key component of AI because that has to get stored somewhere. And so we've seen this sort of massive influx into the data centres, and which is great. So we've got land, we've put a data centre up, but you've got to power it. And it can't be powered by it can be powered by normal base load, but we're moving away from that kind of thing. And so there's
just nothing left to run your house.
or your shower.
Yeah, anything. Yeah.
So we're so reliant on the old school way of electricity, grid, coal fire, that kind of power. It's really hard for us to decouple from that and to move into a new world of whether that's environmental or sun or solar or wind. But uranium has so many more benefits to it. So I know it's hard for people, and I get it. And some people, that's fine. Like when we started, putting Aristocrat in clients' portfolios, they didn't want it at all. But the people who have had it have done really, really well out of it. And I get it. Gambling, people have a bias to it, and it's not right for them. So we've just got to find those things that are right for those kind of clients.
I think as long as they understand why they're saying no is the big thing.
Yeah, that's a good call.
If they know that's gambling, they accept they could make money, and they say, okay, that's fine, I don't want to do it. And that was probably Sam's point. He goes, I just don't want people missing out on returns if they don't understand why they're missing out on it. Yeah. And just educating that and there's so many more layers to it than just nuclear weapons or whatever it may be. And people just haven't been exposed to it. Like in Europe, they're everywhere, aren't they? Like I think France probably has 50 on their own. Like there's
and they're opening up more.
Yeah, and here we don't.
Yeah, no.
So it's just different. And most of the time, if people don't understand it, it's different. We don't like it.
That's a good call as well. Yeah, it's interesting because you sort of look at the way it comes through and the way it's clients, and they just don't understand. And you sort of go, I mean, you don't want to be forceful because it's their money. It's not my money. but we've also got to have a position. And in finance and in we've got to take a position. We've got to have an idea of what's going on. And so we've got to make a call, and we're making the call. So
that's good. Probably, again, unless you go anything. The other one that, again, jumping sideways a little bit was telex. Is that how you say it? Again, and a little bit of education on that one. Again, it's been rolling through in recent weeks. So tell us the why on that one.
Great story. It's been done really well, which is great. Telix is a business that has got a couple of things going for it. One, in a biotech, it's unusual to have revenue, right? Because biotech's basically, it's a binary outcome. They put lots of money, lots of grants into a project. It either says it's going to work or it doesn't work, so binary outcome, right? But what Telix has got has actually got a couple of lines of drugs that are coming out that actually generate revenue already. Fantastic, right? So that takes away a lot of the issues that we're going. They do a lot of cancer stuff, and it's a very specific drug specific line that they're moving in. But overall, Telix has been a fantastic story, and the reason why it's now starting to ratchet up further is that they've just listed on the NASDAQ. And so the NASDAQ holds a higher proportion of valuation to biotechs than here in Australia. And so what happens is when you start trading on the NASDAQ, it'll trade overnight on the NASDAQ, and then we correlate that with what the Aussie stock is doing, and it will follow what's happening in the US because there's a CDI, so a chest depository interest receipt. So then it starts to move. And so the NASDAQ is now starting to move higher, and it's moving as well. So it's a very, very good business, got revenue, and it's just gone into the top 100. So we're getting a lot of index buying coming into that as well, which is pushing it higher again. Yeah, and we're really comfortable with that business.
Probably not a space we've had much exposure to.
No, we stay clear of a lot of the biotechs.
Yeah, because of what you probably just said is
the binary outcome. Yeah, so it's either does the FDA approve it, yes or no? Bang, yeah, yes. Thing goes high, no. Thing just gets absolutely crunched.
I always think of it like those little miners out in the middle of the Pilbara digging holes, hoping they hit something. Like it's the same thing. It's just like yes or no. You can make it big, or you can have nothing left.
So that binary outcome becomes less binary when you've got revenue, you've got a business that sits behind that. And so if one doesn't work, you've got another 3 or 4 behind that to make it work. It's not just a one thing, it's multiple things. And again, getting into that top 100, you get that index buying, you get that pushing in, and that just keeps it moving forward as well. So, it's a great story.
Yeah, I like it. Again, adding another layer, adding a little bit more diversity around that portfolio.
Our market's small. We've got banks, couple of supermarkets, a telco, and some resources, right? So we don't have a lot of that kind of good quality biotech businesses that are doing that. And so when we find one of those, we really sort of gravitate. And we were late to the party. We started recommending about $18. It's $24, $23 now. So we were late to the party. There was a lot of risk that was taken out at $10, $15, So now it's we feel more comfortable to talk to clients about those kind of stories.
I think one of the people fear they've missed out on, and probably the hard part entering at 18 when it was, say, 10 not that long ago, people feel like, it's already had its run sort of thing. And how many people sold out of or didn't buy CSL maybe over the journey, and they just continue. If it stacks up and there's growth and there's benefit and there's reason, we'll keep going.
Well, CSL was the first stock to get to $100 on the Australian Stock Exchange, and it was a momentous occasion. I mean, I remember watching it go tick over 99, 99, 99, 99, and we're like, 100, yay. Now it's 280, 300.
350 has it got to something? Maybe not quite. Yeah.
So, it sort of never looked back from that. Zero is a classic example of that as well. We've done really well on that. It hit $180 yesterday, right? So,
was it under 75 not that long ago?
Yeah.
And it had been to maybe 150 prior to that too, though, wasn't it? And there was that assessment of when they dropped down. And there's no real reason that should be this low.
And it's the perception of the market that potentially the growth isn't there. But if you look through the subscriber numbers, if you look through what was happening, you could see that groundswell still happening, and hence why we were sort of happy to get in and probably over that $100 mark where you potentially thought you missed out on it, but you hadn't. And that's where we sort of really started to push it and move it forward.
Yeah.
I was going to say, has Brooklyn got any more Any queries?
Kicking them off. Actually, one she didn't mention this, but it was one that I thought, again, we're talking about Commonwealth Bank, Transurban, like it's another stock that people have held for a long, long time. And again, I think it's like that Aussie thing of like, oh, it's been good to us. But if you actually look at it over the last, I would say 5 years, but it's probably a bit longer, it's actually gone nowhere for a long time. Absolutely. And it's not like it pays a bumper dividend or anything like that either.
So it's seen as a defensive part of the portfolio. So APA and Transurban are the two, and we used to have Sydney airports and all those kinds of things, but they're all gone. But Transurban has been one of those businesses, and the reason why it doesn't go doesn't go up too much is it's got a lot of debt, massive amount of debt. But that's how these infrastructure businesses run, on debt. And so you've got these massive rollovers of 10 years, 20 years, and 30 years. One of the best things that Transurban did back when interest rates were near zero, they rolled all of their 30-year debt that they were paying 6% out, and they've rolled it all into paying literally zero for the next 30 years. And so that debt component has actually really come away from what they still got a lot of debt, but the cost of that debt, and usually is seen as a bond proxy. So if interest rates go up, then that is going to cost them more. The problem is, I think, with Transurban is that there's government intervention now, so they're capping the amount of tolls that people can have. So $60 a week kind of thing, they can cap that amount. So it doesn't allow Transurban to lift up that profile, as well as then the government has actually been, they build the roads and then they stuff it up, and then Transurban comes in and buys it off them for $1, not $1, but buys it off them really cheap, brings it back up and gets it running again. Whereas the government's actually kept a lot of these infrastructure plays now that they've been building, and they've been doing it themselves, and it's actually been working in their favour. So Transurban is a defensive part of the portfolio. It doesn't do a lot, pays a small dividend. We like it because it can raise prices regularly, but we have been selling it in clients' portfolios because of that cap, the cap that's happening. But also, we're in a growth phase in the market, and you can't have too much defensiveness in there. You've got to be in that growth phase. Now, if clients are very much income focused, we'll probably keep it because it does provide a regular income. But we want to be in the growth story, and I think next year is going to be that growth story. So we're sort of cycling out of that defensive stuff to put more growth in there. But we will be going back to Transurban because it is of that defensive nature of the business.
That's what's really important. It's not like this thing's done, like it's run out of life. It's more about it just doesn't fit where we're at in the cycle.
Yeah. And look, clients obviously, income focused. They'll probably, look, I really like it and it's done well for me and I get a good income out of it. But there's plenty of other places that we can get some good income as well. So
yeah, and it's only 50 franked, is it?
Yeah, or even 40. No,
so it might be less. Yeah.
Most of those bond proxies are struggling, or REITs, those kinds of things, don't have a huge franking component to them.
Yeah, that's ticked off my list of little ones.
Well,
I'll find some.
I need a new nuclear reactor because my computer just went.
But you've blown it up.
Adam stole my charge. Talking about opportunities, you mentioned that things are looking good for the next 12 months. But where else are the opportunities? But also, what are you concerned about? Where are the greatest opportunities? Let's talk domestically, and maybe what do you see as maybe some of the biggest risks outside of sort of American isolationism and tariffs?
Yeah, well, obviously China is probably our biggest risk that we've got at the moment with Australia. China did a big stimulus package a couple of months ago, but it's stimulating the consumer. It's not stimulating the property market. And when they used to do it, they used to stimulate the property market, and from that would be direct correlation to our iron ore and to steel and manufacturing, and then that would then boost iron ore and boost BHP, Rio, Fortescue, those kinds of businesses. But they've now doing more of a consumer-led stimulus, which is more around wealth, understanding, and making that consumer, lifting the consumer up from maybe that lower end to the mid end, and obviously higher. So that's a big thing for us because we've run on the coattails of China for so long, right? Just so long, and so that's been a really tough one for us to sort of work out. And I think that's a big thing that we've got to be mindful of, is that the resources aren't going to be what they used to be. But resources are part of a cycle, and we're at that cycle. So I think China for us in Australia is a big issue. Governments obviously are going to be an issue for us going forward. Cost of living, I think, is still one of those things that is starting. And I really like Woolworths, and down here it's sort of $30. It's really sort of, if you look at over a 10-year chart, there's only been a couple of times where it's been sort of down here and bounced in that support line. So we've been doing a lot of buying in that sort of consumer staple space, because I think everybody needs bread, milk and cheese. But there's caught up with that ACCC and cost of living and all those kinds of things, but that'll blow over. So I think cost of living is an issue. China's definitely an issue. And I think then probably for us here in Australia, just getting out of our own way, as far as, we have these fantastic businesses, but then they disappear or they get taken over. And we've seen so many businesses getting taken over, or mergers and acquisitions last year, that it's going to really struggle to find good quality businesses now left on the Australian Stock Exchange, because we don't have that fundamental incubation phase where we bring these businesses up. And if they do, like Canva, they just go overseas, and they do very, very well overseas, and we can't keep those businesses. So we're a product of, we've got to get out of our own way sometimes and allow businesses to flourish and move forward. But that's a harder one to quantify and work on. So yeah, but I think China's probably going to be our biggest issue next year.
And on the flip side to that, opportunities, where other than what we've already talked about, where else are the opportunities, do you think, in the next 12, 24 months?
So I think AI is definitely going to be a place where we can certainly look at for opportunities. Goodman Group, which we've been had in clients' portfolios, Goodman Group's now turned around and said for data centres, so this is data centres AI, but data centres is a fantastic opportunity. They've got so much industrial land in America, and they're kind of converting all of that to a data centre. So again, there's natural uplift in something like a Goodman Group. In the smaller space, AI in healthcare, I think is going to be a really amazing space. And there's a small company which we haven't ventured to you guys, but your disclaimer again, I own some of this one, but it's a business called Echo IQ, or EIQ is the stock code. But basically it is using AI for heart stent and then heart failure. But heart stents at the moment, you'll go into a cardiologist, he'll take images of your heart. He would normally send that to another specialist who would then look at it at 9 o'clock at night after looking at thousands of other images and go, yep, he's fine, or no, he's not, and then send it back. 2 weeks later, you'd go back into the doctor and he'd say, look, we need to operate.
Do you own McDonald's and Coke stock as well? It seems like a...
So from there, what's happened is AI, and Australia's got the largest amount of images of heart images, or echoes they're called, in the world, the largest database. And they've allowed this company to get access to this database to actually look at every different, and so AI has basically gone through and started to look at all the different images, and AI now within 20 minutes can pick whether this client needs to go in for an operation instead of 2 weeks later. And then if you've got the doctor over the top of it, it has a 97% success rate to picking that if there's a the stent failure. They're going back to the FDA in December, so now they're going back to FDA for heart failure, and that's a 4 times bigger market than what they've got existing just on the heart stent one. So I think AI and healthcare to support each other for these kinds of businesses is going to be an amazing opportunity for us here in Australia.
The AI thing, it's about supporting, not overtaking it. Like you just help using it to assist in those industries, whatever it may be, to make them more efficient and safer.
Absolutely. So they've just signed a contract in the US for a heart hospital which does 300,000 images, I'm going to say, a year, or heart testing, so 300,000 images. They're going to get, the US, you need to get a code, which is like where you can get a certain payback from the insurer. Once they get that code, that 300,000 heart images they're going to be already into, and they'll be generating revenue straight away just from one hospital. And there is going to be thousands of hospitals in the US that are going to need this kind of thing. So supporting, I agree, and that's the right way to look at AI. It supports us in our jobs. It supports us. It's not taking over the world, but it is certainly a way to support, and especially healthcare, I think, is something that it's going to be amazing in.
Yeah, I guess you already probably talked about earlier about data centers and all the other. It's all those offshoots of those things, isn't it? That's where you got to, around that peripheral that you can pick up.
Yeah, so you want to be buying the shovels and the picks, or selling those shovels and the picks, versus sort of you being the miner going in there. You want to be the guy that's selling all that stuff to them, and that's probably where the data centers are sitting, because Meta is already run, Google's already run. These big companies have already had a fantastic run. But they're using AI, again, to lessen staff and to make their life a lot easier. But the side of that is the energy component, and the data storage is just massive, and that's where we're sort of playing it at the moment.
Talking about tech and energy, I know we're probably running a little bit light on time, but we wouldn't be able to let you go without talking. We mentioned it before we jumped on about crypto. Obviously, we do get lots of queries and questions about crypto. It's kind of exploded post Trump's election, his election win, and Dawes and a whole heap of other things that are happening in the US. What are your thoughts around crypto and crypto adjacent assets, investments that people could invest in, and are you looking at it at all in your client portfolios?
A really difficult one, because we do get a lot of questions, 2 to 3 a day. How do I get crypto? Just like you guys are getting that question. There's a couple of ETFs that I pushed client or shown clients that this is a way to do it. I don't recommend crypto to any client. I've got 3,000 stocks to look after on the Australian Stock Exchange, so to add on another couple of thousand alternative coins and Bitcoin is really tough. I think overall Bitcoin is going to serve a purpose, and we now know that where there's so much cold storage wallets, so in other words, taking Bitcoin out of the system and putting it with large fund managers, hedge funds, all these guys, they're putting that allows that to sort of move on. We know Bitcoin is only got a finite life, or there's only a certain amount of Bitcoins that are going to be made. So that again, supply and demand, it pushes it higher. I think over $100,000. I think we spoke to a professional in the space just last week, and they agreed that it can continue to keep going with the politics that's happening in the background. And that's one of the things that has held it back for so long, is governments don't really want to deal with it. Trump, on the other hand, has actually said, yes, I'm willing to go with this and do it.
I think he just made an appointment, didn't he? His security and investment nomination is pretty crypto friendly. Yep,
up over the 100,000 US a mark. So again, clients shouldn't be chasing it up here. I think you just got to be a little bit careful, and it's very volatile. We've seen too many of these FTX, Mt. Gox, all of these businesses, all these platforms just collapse. And I heard the other day that the US government is now the largest holder of Bitcoin in the world, because they've basically took all this stuff from all these other platforms, from fraud and all that kind of stuff. So they're just sitting on this massive amount of these cryptos as well. It's a great sector. It's an interesting sector. Too volatile for us to make full recommendations.
The really big challenge with it is how you value it. Like again, we were talking earlier, and we've talked a lot about, you're looking at the income stream, the assets, the liabilities, the fundamentals of it.
There's not much fundamental.
There's not really fundamentals. Like it's all sentiment,
and driven by excitement. So fear and greed still are the two major emotions that run our markets, and that's why AI will never be able to pick market directions, because we are still irrational beings, and we will move markets around, which AI can't handle. But yeah, Bitcoin is a bit tough space at the moment.
And you got anything in closing for Adam before we wrap it up?
No, I don't think so. I think we've covered some good ground there.
Yep. Any closing call to action, Adam? Any messages for the Christmas break and what to expect? I know we've talked through most things, but any other closing comments?
I think everyone just enjoy the time, because when we get back into midway through Feb, it's just going to keep going, and I'm really excited about next year. I think it's going to be a great year. One thing that I would say is that there's a lot of work been done on the first year of a new president coming in, and that first year markets always tear to the upside. So sort of now is the time, if you're looking to put some more money into the market, it's a great time to be looking at it. Don't wait till July, September next year. I think, sort of rational heads should prevail, and but it's going to be a good year next year, so I'm really excited.
That's good. And maybe the closing comment there around getting excited about the market is that one of the benefits of having the likes of yourself and Sam and Ben and the team here looking after client investments is that things change. There's volatility, and most things shouldn't be set and forget. You've got to continue to, as you said, Ben, sort of assess the fundamentals on an ongoing basis, and I think that's what you guys do exceptionally well, and that's what we continue to value, having you in our corner. So, Adam, thanks for making the trip down. Not far back to Avalon to get you home. Ben, thanks again, and we'll see you in the new year, mate.
Done.
Thank you.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.